Hello, everyone. Today on the Final Bar, we'll talk about this choppy Monday coming after Wednesday, Thursday, Friday last week, really pushing aggressively to the upside. The S&P, the NASDAQ sort of settling into a choppy phase today. Energy back at the top of the list, followed by materials. So certainly a cyclical leadership to today's trading. We're going to look at all of that and also talk about how the short-term fluctuations recently fit into the long-term, particularly key levels on the S&P. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market activity using the power of stock charts, using the technical analysis toolkit to better understand market behavior. I've gotten a lot of questions in the last couple of weeks about the trend following nature of technical analysis. And I've had people that have written, particularly, we've talked about the bearish overall phase that the market, I would argue, is still in. You had the bounce toward the end of last week, and I had people saying, how come technical analysis can't be more forward looking? How come we can't anticipate those kind of things happening? And I would argue you actually can. It depends on what kind of toolkit you're using. Remember that the technical toolkit we describe on the show is basically what you could describe as a trend following toolkit. Our job is, or our goal is to identify trends and follow those trends. But the third piece I would argue in that approach is to anticipate when the trends may be reversing and to make sure you start managing your positions, managing your risk because of the potential for a trend change. So we've talked about the short-term strength and how that relates to the long-term weakness, what key levels we would need to break or what key signals would tell us potentially to reverse course. And there's plenty of the technical toolkit that is actually a little more forward-looking. And I encourage you to experiment with things like divergences and exhaustion techniques to try to anticipate some of those turns. We have great guests on the show. We had a couple of really good discussions last week with our guests. This week, more of the same. Tomorrow, on the 22nd, we have Peter Brandt, trader, educator, has had a fantastic career in the markets and always brings some really good expertise along with his visit. On Wednesday, the 23rd, Willie Delwich, who's the strategist at All Star Charts. On Thursday, the 24th, Roman Bogomazov, he's an educator and expert in Wyckoff analytics, which is an interesting framework with which to approach the markets. Two other things to let you know about. Our 2022 edition of Chart Madness is coming up on the 24th. That's Thursday of this week. Go to stockcharts.com/chart madness. You'll see the bracket of 16 stocks that we selected. You'll see some information about the four experts that will be picking their brackets. You can download your own bracket today. Fill in your guesses as to which will perform the best over the next 6 months. Go to stockcharts.com/chart madness for more info on that. Also, my next webinar with market misbehavior is coming up tomorrow. It's called 5 Key Charts for Market Sentiment. You can sign up for free at marketmisbehavior.com/sentiment. We'll talk about market sentiment indicators, things like the VIX, the name exposure index, RIDEX flows, put call ratios. We'll break down how they're constructed, look at some market history, and see what sort of signals they provided and what they are saying now about the markets. That's tomorrow, 1 p.m. Go to marketmisbehavior.com/sentiment. Let's continue with our market recap, breaking down some of the key activity of the day. We're starting with the member dashboard on stock charts, and you can see the difference from Friday to today. Now, I was talking earlier with my friend David Chung, who's one of the editors at Investors Business Daily (IBD). Does such a fantastic job and has for a number of years. We had a really good discussion about just this market environment, what to make of the short-term rally last week, and what the forward looking the next couple of weeks may hold in store. And one thing we talked about is how Friday really, I mean, you look at the huge move to the upside on Friday. Now, Wednesday, Thursday of last week, as we moved to the upside after the Fed meeting, legitimate bullish, at least tactical time frame, short-term time frame, legitimate bullish behavior coming out of a pretty beaten down level. Nice rally. Friday, you have to put a little bit of an asterisk next to that one, only because it was quad expiration date, meaning a bunch of options contracts are expiring, which means there's usually an influx of volume and a lot of volatility. And it's more just because of positions that have to be changed. It's less about a directional bet than investors are necessarily meaning. So after that is behind us today, we get choppy. And early in the afternoon, we were down just below 44.30. The S&P closing right around 44.60, pretty much flat for the day, to be honest with you. It's not far from where we were on Friday of last week. The NASDAQ, by the way, a little worse, finished down 0.4%, but had been down a little bit more earlier in the day. Small caps, the worst performer of the three that I just mentioned, down about 2/3 of a percent. The VIX, by the way, still fairly low relative to where it's been the last 6 weeks or so. It's just below 24 now, around 23.57, and that's down from where we were on Friday. A lot of movement in the bond markets. You have bond prices coming down fairly aggressively. 10-year yields moving to a new swing high above 230. We've talked about the idea of rising rates. We've talked about the ripple effects of what a rising rate environment would mean. And as we go through this, sort of macro component to the discussion, hopefully we'll get to a chart of the 10-year yield here in a few moments. Dollar index up just a little bit, about 1/3 of a percent using the UUP. A lot of movement in commodities as well. I mentioned energy was up significantly. Oil prices up pretty good. The USO was up 6.5%. That's a crude oil tracking ETF. Gold and silver up as well, both up around 1% or so. On the crypto side, a bit of a divergence between major cryptocurrencies, but most of them were up today, with Ethereum up about 2%, still not quite making it to 3,000, although it got up above 2950 earlier today and over the weekend as well, but still below that 3,000 level. I would argue that's a key indicator of a next rotation higher on Ethereum. Bitcoin currently below 42,000, just above 41,000 actually. Let's look at a chart of the S&P, and we'll touch on some of the other macro charts. Then we'll continue on today looking at sectors and looking at individual stocks, and that'll take us right to the end of the show. Chart of the S&P looks like this. I would argue we're sort of in a choppy phase, right? And various guests of mine have described that in different ways: sloppy, choppy, consolidation, sideways trending. All of these ways to describe this sort of volatile but uncertain market. It's one of those where if you're bullish or bearish, I feel like you could draw on certain evidence on this chart to back that up. And that's a dangerous time in the markets when it feels like you could justify either side. That's why I would probably describe the market overall as neutral here. It's still, I think the market is in a pretty decent downtrend. I think breaking above 4,400 is one of the reasons why I'm not end of the world bearish at this point. Remaining above 4,400 would be a key support level, of course, to maintain. But the RSI broke above trendline resistance. The price broke above a trend line on the 2022 highs from January and February. That's all pretty constructive, particularly on the short term. Now, the question is on the long term, how does this chart start to look more constructive? Well, forget about individual stocks because we'll get to those in a little bit. I would say for the broader market, you really have to start getting above some of these earlier highs from February, right? The market's inability to get above 4,600, stalling a couple times there in February was pretty key. That's a 61.8% retracement, by the way, of the initial sell off in 2022. From there, that 4,200 level has essentially held. We've traded below and even closed below it a couple times, but never 2 days in a row. We've sort of rotated right back above it very, very quickly when we've seen a breakdown. So that's sort of a long-term Fibonacci support level, drawing from the September 2020 low to the January 2022 high. On the shorter term, that 4,600 level would take us above the February highs and take us above the last Fibonacci resistance. We get above there, I'll start talking about the S&P going to new highs, talking about an acceleration to the upside, potentially into May. That would be sort of the very poetic way that the market could play out. If you see strength now, you strengthen into May, which would then mean sell in May and go away could be an ideal way to play this year. Doesn't work particularly well at times because May through November last year was actually pretty strong. And usually November through April is the stronger 6 months of the year. So last year, sell in May and go away was a bad call in general, right? And that's why it's a tendency. It's not an absolute. I wish it was that easy to play the markets at the top level. So at this point, I think we're in no man's land. Testing the 200-day is the most urgent signal. The fact that we're not making lower lows right now is encouraging. The fact that we've broken above the most recent swing high and trendline resistance is all encouraging. Can we get above the 200-day? Ideally, we get above 4,600. That would clear the way to a return to all-time highs, if not higher. And I think if we do that, you'll hear me start talking about S&P 5,000 as being attainable. But for now, we have to get above short-term resistance. We haven't been able to do that quite yet. Now, one of the interesting sort of many narratives we have right now are 10-year yields. Here we're looking at dollar sign TNX. I have a couple things on here as well, and we shared this chart last week, and I just wanted to revisit it briefly as we're talking about the macro environment here as our first step. Interest rates are going higher, and you really saw the follow through to the upside, getting above 230 for the first time since early 2020. So we're going back to the March 2020 low is when we've had interest rates this high in recent history. Sorry, that's 2019 back here. It was March of April, May of 2019. Excuse me. So we're going back a couple of years to the last time we were this high. Now this is value over growth. So when rates go higher, value stocks tend to outperform. So since November it's been value over growth. Now, with some quick, brief pullbacks, and I would argue that's what we saw last week, sort of a mean reversion with technology working and things like energy coming off of a fairly extreme level. We'll see if this, continues to trend upwards. If rates go higher, most likely that's the case. Now, the problem there is the fact that the yield curve is flattening. It's actually getting very close to inverting. If you look at 2 years, 10-year yield minus 2-year yields, the twos versus 10 spread what you often call it. That getting below zero, which we narrowly avoided, I would argue, in 2019. But when that goes below zero, that usually is a sign of an impending recession. Usually not a great sign for stocks overall. So we have an interesting combination of rising rates, but a flattening curve. And it's a fascinating time to be paying attention to interest rates. I would pay attention to each of the three series on this chart for sure, starting with the 10-year yield. We need to go to our next segment, sector setups. Let's talk about the 11 S&P sectors. Big picture with the S&P rallying in the short term, certainly last week after the Fed meeting, and now the question is, what's next? Was that a short covering rally, a brief respite before the next move lower, or is that the beginning of further upside appreciation? I would argue the former versus the latter. But let's look at some of the individual sectors and how they relate to that big picture discussion. Here's the RRG. Again, this is created by Julius DeKempener. If you go to his show called Sector Spotlight, you can get to that on demand at stockchartstv.com. He does a great job of using this methodology and explaining it in a lot more detail during his show. Here we have the energy sector as the strongest of the 11 by far, and up and to the right is stronger, right? And an ideal strong performing sector would be in the leading quadrant. It would be heading northeast, and that would be a position of strength. So it's close. It's furthest to the right, which is good. It's in the leading quadrant, which is good. But it's starting to slope down a little bit. And ideally, this would be heading more northeast. That would be showing strengthening momentum. It's pulled back because of the sell-off that you had in pretty much the whole energy sector here in the last last week or so. But worth noting to see if that can revert back to trending northeast, which would be more ideal. Same with consumer staples. That's the second strongest sector, but actually rotating a little bit weaker again using weekly data. So what's emerging? It's a zero sum game essentially. So if these sectors are starting to rotate lower, what is starting to work? It's interestingly utilities, which is actually right here. We can zoom in a little bit, by the way. Let me make it a little easier to see. So we have utilities here and we have healthcare. Those are the two sectors that are actually improving their condition in the leading quadrant, heading northeast, showing signs of strengthening. You guys got about the growthy stuff. It's all here in the lagging quadrant. So the three sectors in the lagging quadrant, technology, consumer discretionary, communication services, they haven't improved anywhere near enough to be really considered constructive at this point. I would argue it's still energy by far number one, and then it's utilities and healthcare that are really emerging and showing some signs of strength. Let's look at the 11 S&P sectors now using the candle glance function. This is a really cool feature that allows you to bring up a bunch of charts on one screen, and it's a fantastic way of comparing patterns across a bunch of different things. So it's great with sector ETFs, really good with a series of all sorts of ETFs to just sort of see different themes with industry groups or with individual stocks in a portfolio can be very, very helpful. Here you can see a couple different things. Energy by far the outlier. We talked about that on the previous chart, but look how it's literally the only one as I'm glancing around these 12 charts that is above two upward sloping moving averages. Energy is pretty much it. Everything else is in some other phase where it's attempting to regain its 50-day moving average. It's attempting to get back above moving averages and so forth. But overall, energy is by far the number one. I changed my mind. Utilities, I would have to bucket that way as well, right? Above two upward sloping moving averages and actually testing new 52-week highs here, very close. So it'd have to get above 72 on the XLU. So energy and utilities, the two strongest one. You can see also some movements in some of these sectors. We haven't talked about a ton. We really haven't talked about industrials, although some of the biggest gainers today. When I was looking at the list, you had some industrial names that were they're actually looking pretty constructive. I'll save that actually for our next segment, shifting stocks. But industrials actually showing some signs of improvement. Materials as well. Now we have talked about materials, and stocks like Nucor and Mosaic and others are in that sector and actually doing incredibly well. Some of the others in the sector are starting to improve, which is causing it to pop up higher. I was talking earlier today on an interview, and we talked about consumer discretionary versus consumer staples, which is a traditional way to think about offense versus defense using sector analysis. I'm going to go quickly to that chart here because it's a great place to sort of finish this discussion about sector rotation. When you think about sector rotation, I think a couple different things you can be doing. Number one, you can actually be looking for, investment ideas and thinking about rotating into some of the outperforming sectors and rotating away from underperforming sectors, or at the very least, betting on some sort of improvement and mean reversion within the 11 S&P sectors relative to one another. It's also going to be a really good gauge about thinking about relative performance and making some assumptions about risk on versus risk off. One of my favorite ways to do that using sectors is looking at consumer discretionary versus consumer staples. This chart has been really valuable over the last year or so, and I just want to talk briefly about why that's the case. The top half is using the cap weighted ETFs, XLY and XLP. The bottom half is using the equal weight, and that just minimizes the impact of things like Amazon and Tesla that are such a big market cap. It can really affect the ratio on the top. Now, if you look at both of these, again, late 2020, the S&P had a really good run out of the March 2020 lows, consolidated in September and October, finally broke out. And I would argue this ratio, and both of these ratios, breaking to the upside, particularly the equal weighted version in November, was a great indicator of risk on. It was telling you, because at the time it was sort of a question mark, right? The S&P was consolidating, NASDAQ was consolidating. They started to break out. This equal weighted ratio breaking to new highs was one particular way to recognize renewed strength. Same thing here toward the end of last year, right? If you look in September and October, both of these ratios broke out to the upside, which gave me some pretty good confidence that the S&P was going to, move higher through year end. But look at how both of these ratios topped out in November. So the S&P was making new highs in January, December to January. These ratios were both moving downwards in a significant way, which told you, even though the indexes were moving higher, it was a defensive-led rally. That is not a bull market feel to the sector rotation. It's more of a defensive feel. We can see that obviously was a great leading indicator of the weakness in stocks. Now, what about now? You can see on this chart some of those bear market rallies that we saw in December. Another one here in February, where the ratio starts to rip higher just in a brief minor way. We've seen another one of those in the last week or two. Now the question is, can we eclipse the previous swing highs? That's why I think this is an important chart to review, because if we're bullish, if we're thinking constructive here, if we think the S&P can regain 4,800, these ratios, I would argue, would need to get to a new swing high. Would need to get above the February high, which would tell you investors are getting back to offense. It's not completing that signal just yet. Let's take a quick break. We'll be back with my next segment, shifting stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close for our show. A couple quick announcements before we get to my next segment. First off, we welcome your questions. We'll do a mailbag segment on tomorrow's show on Tuesday of this week and another one at the end of the week. We'd love to feature one of your questions live on the air. Our email is thefinalbar@StockCharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. Hope to answer one of yours in our next mailbag segment. Also, go to StockChartsTV.com. That is our on-demand platform. It's completely free. I was talking to Larry Williams last week. He's done some fantastic market outlook specials so far year to date. Martin Pring did a really fantastic big picture overview back in January. We've had so much other great content like special episodes of The Pitch, some feature presentations celebrating Women's History Month. So much great content, a lot of great market discussion as well. StockChartsTV.com is our website, or on your mobile device, just search for Stock Charts TV on demand. Our next segment is shifting stocks. We talked about the big picture, the overall environment with what I would still label as a bear market rally. The S&P rallying significantly last week, but still attempting to get above some key resistance levels. Talk about sector rotation, and really we're going to focus a bit here to start on the renewed strength in the energy sector, and then we'll get to some of the other individual names as well. We didn't talk about today's move, but energy up 4%. And what you'll notice recently is energy has pretty consistently been either the number one sector or the number 11 sector, and it's not been close. It's usually been far the outlier to the upside, far the outlier to the downside. And if you look at the 10 stocks making the biggest gains today in the S&P, almost all of those are energy stocks, besides something like Nucor, besides Mosaic, which is in materials. The rest of these, with a quick glance, all are energy names. It tells you the strength that you've seen in that area of the market. Also, the top 10 scooter rank stocks. You have Avis, which is number one. That's because of a huge percentage swing. It's one of the meme names that are still kind of going, but most of the rest of these are all energy with a little materials peppered in there as well. It shows you the strength in that part of the market. And again, it's kind of classic behavior for this part of the cycle, as you would probably assume leadership from some cyclical stuff like energy. If we are in a bear market phase, you probably see things like healthcare and consumer staples start to itch their way up the sector summary table and start to have some decent, particularly relative returns. Right, you assume that those would tend to outperform if the market's getting defensive, as well as utilities. So those all in the sort of mid to top half of the list today. By the way, before we get to the rest of shifting stocks, I did want to just go back because I meant to mention this in our macro discussion. This is on Twitter at Sunrise Trader, and I don't know who this is personally. I appreciate you using stock charts and sharing some really beautiful charts on the Twitters. But I would point out this one in particular. This reminds me of a Grayson Rose trick. He has a chart list where the price is actually invisible. Right, you actually turn the price data off, and you're just looking at moving averages. Every time I see him share those, I write on a piece of paper, set up more moving average charts, and I put it on a pile that I wish I got to more often, because it's a great way to get rid of the noise. And the comment that he tweeted out, I think, is fair, which is the long-term moving averages still sloping downwards, the short-term moving averages showing strength, and that sort of fits into the bear market rally, or what he called a short-term, or he or she called a short-term bounce rally. And I think that's a great way to visually illustrate that, by the way. And if you don't know how to set up the chart with the price invisible, hit our support desk. They can explain to you, of course, how to do so. Continuing on here, I wanted to focus on a couple key charts to wrap up the show. Home builders selling off a bit today. So again, the S&P and NASDAQ essentially flat to a little bit down. Lennar Homes down almost 5% today. What's interesting about the chart of LEN is I did a trend line from the June low of last year. That lined up with the October low of last year, also late January and February lows. And again, I was told with trend lines or support levels, once is chance, twice is coincidence, three times is a pattern. And what that means is the more you test a trend line, you further validate that it's a great way of visually representing the trend in the market, or in this case, the importance of that support level. Now, look at how that changed in mid-February as we broke below that support level around 90. And from there, we've actually had a number of failed attempts to regain that. So we had a level of support, we broke below it. We're now testing that level from below. And my question is it able to get back above 90 and hold it? Until it does, I'd have to label this as more of a bearish chart than a bullish chart. And this is a big basing pattern, potentially resolving to the downside here. And again, I think that's the weight of the evidence at this point. Regaining 90 and holding it would certainly make that less of a bearish chart, but that's an important one to pay attention to. We'll get the negative stuff out of the way here. Airlines are another one, down over 4% today. So these are some of the groups that struggled the most today. Now, what's funny is last week, these are some of the most bright and shining emerging stocks leading the way higher. You had Delta coming off of support at 30, which again was yet another lower low among many over the last year, but then sort of rotating back and trying to get back into this range that we spent really the last 6 to 8 months around sort of 34, 36 up to the mid upper 40s, so you say 46. From there, though, we're starting to pull back a little bit, and the question for this chart is do we make a higher low, right? If we do push back, and if we do sort of give up some of those gains from last week, are we able to establish a higher low around 32, around 34? If so, that could be how a rotation higher would start to look. But unfortunately, with the sell off that we're having today, it's making me think about what a return to the previous lows would look like, how that would actually potentially play out. So this is why when we talk about a trend, looking at the highs and lows, at this point, you're coming off a lower low. We'd have to get above 45 to make a new swing high, which is a long way away. So my question now is, do we establish some sort of higher low, indicate that buying pressure, buying power is emerging when the stock sells off a bit? Let's look at some of the FANG stocks, and the two strongest, I would argue, remain Apple and Microsoft, obviously within the technology sector. I mentioned talking earlier today with David Sato Chung at IBD, and this is one of the charts we spent some time on as well. This is when you think about some of the more speculative technology stocks, and we'll look at one of those here in a moment. Some of the more conservative, more the blue chip technology plays would be something like Apple or Microsoft. Apple's not a bad chart right now. I mean, it's come down from the 180s to the 150s. That's not a small move. Now, again, it's gained about 15 points since bouncing off 150 about a week ago, and it was also right at the 200-day moving average, which has been a really important level for Apple. So remaining above the 200-day is a pretty decent chart. The relative strength has been essentially sideways. This is a bad place to be. So if I had to own technology, or if I was looking for somewhere to get some potential exposure, a chart like this is not a bad one, only because it's going to probably outperform in an underperformance from technology. If technology struggles, something like Apple is probably going to work. We'll finish looking at the ARK innovation funnel. Something like Apple is holding up. Something like ARK or Peloton or Zoom or any of these charts that I would consider in sort of that ARK bucket, these are underperforming charts. And as much as the bounce last week was great, as much as Zoom is bouncing off of $100, which is a big round number, this is a stock that has continued to make lower lows and lower highs. When that pattern stops, I will stop talking about it being in a downtrend. At this point, though, it is anything. It is nothing but a downtrend by my pure technical read on that chart. We need to wrap this show, folks. Go to the 3 and 3, three charts in 3 minutes. Let's get to them. Chart number one is the 10-year Treasury yield, the TNX, dollar sign TNX, that is. We talked about this chart earlier, and we were going through the macro perspectives. I just want to point out the fact, obviously, a big move higher today as bond prices come down, interest rates moving higher, the 10-year yield hitting 230 for the first time since the second quarter of 2019. That's a couple years ago when we were back up at these levels. Just because rates have come up a lot does not mean they can't go much higher. And I would argue that's probably what the most likely scenario would be. You can see how growth stocks have underperformed value, and this ratio going higher means value is outperforming growth. And you can see that's what's happened really since November. Once that line turns down, then I'll start talking about all the great opportunities we might want to chase in technology. But last week's little blip of growth outperformance was this little downtick in that ratio. I would argue the ratio is still very much favoring value stocks. I would make sure you pay attention to the yield curve, though, getting closer and closer to potential inverted curve. Chart number two, Devon Energy, DVN. We didn't talk about this one earlier. I talked about energy stocks doing so well. I wanted to talk a little about some of those technology names instead, but DVN, Chevron, uh, where else was I going? FANG, Diamondback Energy. These are all charts that are in strong upward trends. They've pulled back recently, and DVN pulled back to its 50-day moving average, making a new 52-week closing high today, up over 5%. These are charts that are still working, and I would put the benefit of the doubt to the uptrend until proven otherwise. These are strong long-term charts. Final chart here. Healthcare is an interesting one. Healthcare has been sort of a non-factor for a lot of investors. We haven't talked about it much only because it's been sort of in the middle. It's been sort of a yawner, sort of a market performer. But UNH is one of those charts that's actually pounded out a pretty good run of relative strength. And you can see, looking at the top here, we're potentially breaking out of a consolidation pattern. Resistance here, which is right around 500. That's where we failed in December and February and March. Are we finally getting above there? Folks, that's our show for today. I want to thank you so much for joining us every weekday after the close for the Final Bar. StockChartsTV.com is where you can go for all of our previous episodes and interviews. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.